Palantir, a stock that's recently been making headlines, is currently trading around $148 per share, reflecting a remarkable 418% increase over the past year. This kind of growth naturally raises critical questions. Is the rally primarily driven by speculation and retail momentum, or is it underpinned by meaningful improvements in the company's fundamentals? Well, looking at their most recent earnings report from Q1 2025, we can see that Palantir reported Q1 2025 revenue of $884 million, representing a 39% increase year over year and beating analysts' expectations. US revenue grew 55%, reaching $628 million, driven by both government and commercial contracts. The US commercial business was a standout, with revenue jumping 71% year over year to $255 million. In terms of profitability, GAAP net income came in at $214 million, up over 122% compared to Q1 2024, reflecting a net margin of approximately 24%. This marked Palantir's sixth consecutive quarter of GAAP profitability, highlighting a sustained trend towards financial maturity, and earnings per share came in at 0.8 cents on a GAAP basis. Moving over to cash flow, free cash flow for the quarter reached $370 million, giving Palantir a free cash flow margin of 42%. And operating cash flow was also strong at $310 million, or 35% of revenue. Looking at customer growth and contracts, total customer count increased by 39% year over year, reflecting broader adoption across both commercial and government segments. Now let's talk about their valuation, a topic we cannot skip when talking about Palantir. The stock trades at extreme multiples. Price to sales is above 100 and PE over 300. Making the risk-return profile unattractive for new investors at current levels. Despite its impressive growth, Palantir appears significantly overvalued by traditional valuation standards. With a price-to-earnings ratio exceeding 300, it begs the question, why are investors chasing a stock priced this aggressively? A key red flag lies in the company's PEG ratio. The trailing 12-month PEG ratio stands at 6.55, while the forward PEG non-GAAP measure stands even higher at 7.74. Given the company's projected revenue growth of around 36%, these figures suggest a substantial disconnect between price and fundamentals. To add further perspective, the company's price to sales ratio sits above 100, indicating that investors are paying more than 100 times current revenue per share. Such a high multiple is rarely sustainable and poses serious concerns for long-term investors seeking durable, value-aligned growth. Analyst sentiment on Palantir has remained neutral over the past 3 months. Buy ratings have declined, while hold remains the most common recommendation, suggesting the stock is being seen as fairly valued. A slight rise in sell ratings points to ongoing concerns about overvaluation. Overall, the consensus has consistently stayed at hold. Analyst price targets for Palantir show a wide range, reflecting divided opinions on its valuation. The high target stands at 160, slightly above the current price of 148. While the median is notably lower at 110, and the low estimate is just $40. The average target of 108.86 suggests that overall analysts see downside risk from current levels, reinforcing concerns that the stock may be overextended in the short term, despite strong growth momentum. Palantir is set to report its Q2 2025 earnings on August 11, 2025, with a current EPS estimate of 0.14, unchanged from a month ago and slightly up from 13 cents 3 months ago. For Q3 2025, the consensus estimate has remained steady at 14 cents over the past 3 months. The stability in earnings expectations suggests that analysts have a consistent outlook on Palantir's near-term profitability, with no major revisions despite the stock's recent volatility. Overall, yes, Palantir is undeniably overvalued by traditional metrics, but personally, I see real long-term potential as the company continues to scale deeper into the enterprise tech space. If you're considering starting a position, I'd recommend waiting for a potential pullback. With that said, earnings is just a few weeks away and the stock could swing in either direction. If you enjoyed this video, make sure you subscribe for more deep dive stock analysis and drop a comment below letting me know which stock you'd like me to cover next. Thanks for watching and I'll catch you in the next one.